मोबाइल देखो मोबाइल मिरर कैमराटा ऑन करो कैमरा चुटीटा देखि साइज कर
उठी चलो अच्छा चले छोट Good afternoon, friends. In today's class, we will discuss a new concept of finance, that is behavioral finance. Before discussing behavioral finance, let me first tell you what will be the objectives of our class discussion. First, we will discuss the meaning and concept of behavioral finance. Next, we will discuss different characteristics of behavioral finance. Next, we will discuss different behavioral biases and their impact on investor behavior. At last, we will discuss the behavioral consideration for investors. Let me first tell you what will be the structure of our discussion. First, I will give an introduction to behavioral finance. Next, we will discuss some scope of behavioral finance. Next, characteristics of behavioral finance. In that context, we will discuss behavioral consideration and application of behavioral finance. We will discuss branches of behavioral finance. We will discuss some financial theories. We will make a difference between traditional finance and behavioral finance. Next, we will discuss whether behavioral finance is a science or an art. Then we will discuss application of behavioral finance in stock market. And we will discuss some decision making errors and biases. We will discuss heuristics, biases of behavioral finance, quantitative behavioral finance techniques. We will summarize our discussion. We will highlight some keywords and we will discuss some self-assessment questions. This will be the structure of our today's discussion. Next, what is behavioral finance? Traditionally, finance has been developed since mid-50s. In that context, we know the traditional financial models assume that the individuals are rational. The individuals are rational human beings. They act rationally. When they enter into stock market or bond market, they act rationally, and stock market and bond markets are efficient. What is efficient? Efficient market means the market reflects all available information and the investors act rationally. But practically, we see that the psychologists have discovered that most of the economic decisions are made irrationally. Just the opposite of traditional finance. All the theories of traditional finance based upon the concept that the investors are rational, but behavioral theories or behavioral finance assume that the investors are irrational in nature. So behavioral finance challenge the premise of traditional finance. Behavioral finance tells that investors make poor financial judgment because of cognitive mistakes. So there are certain emotional bias while taking financial decisions. So the investors in that context take some irrational behavior. So the study of behavioral finance have expanded over last few decades. And in this context, the behavioral finance gained its momentum from late 70s, and the main basis upon which behavioral finance stand is that people act irrationally and they act irrationally regularly. That they do not act irrationally occasionally, but they act irrationally regularly. This is a concept with the inputs taken from psychology and finance. So, behavioral finance is a happy blending of psychology theories and financial theories. With the help of psychology theories, we try to solve some unsolved problems of finance. So, behavioral finance is the application of psychological theory to stock market behaviors. So, in stock market, people act irrationally. Why there is a bubble in the stock market? Why stock market crash? What is the calendar effect? What is different ups and downs in stock market due to the irrational behavior of investors? What are the psychology behind the market movements? We will study all these contexts in behavioral finance. So what is the meaning of behavioral finance? What do you mean by behavioral finance? So behavioral finance emphasizes investor behavior which leads to variety of market anomalies. So behavioral finance hovers around market anomalies. The study of investor psychology when they make financial decision is known as behavioral finance. While the investor take financial decisions, what is going on in their mind, that is known as behavioral finance. So we will study the investor's mind in behavioral finance. So behavioral finance focuses on explaining why investor often appear to lack self-control. They act against their own best interest. Why they make decision based on personal bias instead of facts. In many times, investors take personal biases, take decision on the basis of their personal intuition, not on the basis of facts. Why they do this? All these context we will discuss in context of behavioral finance. So what is the definition of behavioral finance? I have told that Swell has defined behavioral finance is the study of the influence of psychology on the behavioral of financial practitioner. So I have already told behavioral finance is a combination of psychological theories and financial markets. So Sefrin defined behavioral finance as its application of psychology to financial behavior of investment practitioners. And Linter opined that behavioral finance is a study of humans interpreting and act of information to make informed investment decisions. Glaster considered behavioral finance as a sub-discipline of behavioral economics. Glaster tells that behavioral finance incorporate the findings from psychology and sociology into the theories of finance. So behavioral finance refer to as behavioral economics by Blesky and Gilbridge. So these are certain definitions of behavioral finance. Most of these definitions hovers around that behavioral finance is the application of psychological based theories to market anomalies to explain the asset market anomalies. So behavioral finance is defined as a field of finance that proposes psychological based theories to explain asset market anomalies. So behavioral finance explain why market anomalies happens, and they explain this by applying different type of psychological based theories. Next, we will discuss the scope of behavioral finance. What we are going to discuss in behavioral finance. I have already told behavioral finance hovers around one most important thing, that is to understand market anomalies. Why market anomalies occurs? Why there is a bubble in the market? Why there is a effect of an event in the market. Let's take an example. Corona happens. How stock market reacts? Then what is the calendar effect? What is stock market activity? These are all the scope of behavioral finance. So behavioral finance helps to understand the reasons for market anomalies. I have discussed some of the market anomalies are emergence of bubbles in stock market, effect of an event in stock market, calendar effect on stock market activity. These are some of the market anomalies, and behavioral finance give answer to these anomalies. Next, to identify investors' personality. Behavioral finance take a deep look into the personality of the investor. So, how their investment behavior changes as per their personality. So, personality has an impact on the investment decision of the investor, and this is how the personality affect the investment decision. This is the second scope of behavioral finance. Next, we will discuss behavioral finance to enhance the skill set of investment advisors. There are many investment advisors. There are many portfolio managers. They give advice for investment. So behavioral finance give a set of tools to them how they will enhance their skill of advice to their clients regarding based on behavioral finance. It helps to identify the risk and develop hedging strategies in context of behavioral finance. So we are discussing regarding behavioral finance. Next, we will discuss some of the characteristics of behavioral finance. What are the features of behavioral finance? What are the characteristics of behavioral finance? So behavioral finance has some of the following characteristics. The first important characteristics of behavioral finance is framing. So what is framing? Framing means it's the decision maker's perception about a problem and its possible outcome, what is referred to as decision frame. So what is decision framing? Decision maker has a perception about a problem. His perception has an impact on his decision. And so the impact of the perception of the decision maker on the problem and its possible outcome is the decision frame. So we will study decision framing in behavioral finance. Next one is heuristics. It's most important thing. What is heuristics? Heuristics means rule of thumb. Certain people use of experience and practical efforts to answer questions or improve performance. So investors generally develop certain rule of thumb for themselves. Some investors tells that I will invest my money only on Thursday. They have a religious belief. There is a rule of thumb. They tell that when some investor believes that when the market crashes by 10%, it will go off. So it is their rule of thumb. It is their belief. That is known as heuristics. Then next one is emotions. How emotions affect the investment decisions. We know that emotions are the animal spirit. In case of what is the animal spirit? Let's take an example. In finance market, there is a herd mentality. What is herd mentality? The emotions are driven by human needs, desires, fears, fantasies. These are the animal spirits given by John Keynes. These are the inner urge of market participants to engage in investment and consumption decisions. So emotions plays an important part in behavioral finance. Then we study the impact on markets. This is the most important things. We will study the impact of heuristic on financial market, impact on emotions on financial market, impact on framing on financial market. So the impact of these emotions, heuristics, decision framing on financial market are the scope of behavioral finance. They are a part of behavioral finance. Here we will discuss the factor of arbitrage factors. We will discuss cognitive errors and investors make which affect the stock market prices. So next we will discuss certain behavioral considerations in behavioral finance. First one is biases and heuristics apply to all. We know that human beings are usually imperfect. There are certain emotional biases like overconfidence, anchoring, representativeness, which are present in all of us. And all these things affect our investment decision making. Overconfidence affects our investment decision making. Emotional biases, anchoring affect our investment decision making. Representativeness affect our investment decision making. We will discuss what are these one by one. Then limitation of knowing. We know that everybody cannot know all the things. There is a tendency among people to think that the forecast made by them are increasing in accuracy with increasing information. People are bombarded with information. People think that if they collect more information, they will take more informed decision. But practically, the quantum of information is not important. Rather, what we do with this information, how we apply this information, that matters in a financial market. Next, focus on facts. Generally, we know that asset prices should be judged on facts and not on their prices. Many people, many market participants tune out investors' noise. They are affected by noise. One must think in terms of enterprise value, not on stock price. We know that there are many companies whose stock price increases, and if by looking at this, many people put their money in that companies. They think that its price increase and it will increase forever. But please, practically, a person must put his money by valuing the enterprise, not by looking just at increase in stock price. So if this organization is available at a good value, we must buy it. That type of investment is known as value investment. Next, overcoming loss aversion. Generally, people try to avoid loss. That is known as people are risk averse or loss averse by nature. So always people try to overcome the loss. So investors should examine their mistake as it is not always due to bad luck. One should admit one's mistake. There are many people in the market, they make a wrong choice, but they do not admit their mistake and they hold on that share, and the share value comes down and down due to false ego. They have to prove that my calculation, my analysis is correct. They hold on that stock. One cannot be correct all the time in the market. So you have to be correct in majority of the time. But there are many situations which are out of your control. You are a human being. You can make mistake. Admit your own mistakes. But people do not admit their mistakes and they take these decisions. Then informations not to be taken at face value. Please see the information which is given, that one must read the information between the lines. What is there? What is the hidden information? Information is given, information, news is information. But how markets should analyze the news? That is, information should not be taken at their face value. And we have to find out the insight in every information before taking decisions. Next, do not allow emotions to control you. Many investors are emotionals. Most of the investors are emotionals because we are human mind, we are human beings. There are many psychological behaviors like hard investing. When most of the people invest, we will invest. When most of the people sell, we will sell. That type of investing is known as hard mentality or hard investing. Mental accounting. These are some of the strategy which are influenced by emotions. And a good investor must not be controlled by their emotions. Next, one must know investment horizon. No market participant should try to become rich quickly. Nobody has attained success in a minute. Investment is a full-time and long-term affair. It's not a 2020 match. Investment is not a 2020 match, it's a test match. You have to give lot of patience. You have to take lot of patience while deciding the investment horizons. Next, what is the application of behavioral finance? We know that traditionally we have read many theories of traditional finance, or those are known as CAPM. We have studied capital asset pricing model. We have studied the EMH, that is efficient market hypothesis, and we have studied and many other, that is Marquis theories. All these theories of traditional finance are based on one concept. That concept, one assumption, that investor behave rationally and predictably. Rationality of the behavior is the most important assumption of all the traditional theories. But behavioral finance is diametrically opposite. Behavioral finance, first of all, assume that human beings are irrational in nature. Most of the time, they behave irrationally, and in few times it may be behave rationally. Investors behave rationally not all the times. Most of the time, they show irrational behavior which is influenced by some emotions. So, behavioral finance explain why individuals do not always make decisions they are expected to make, and why markets do not reliably behave the way they are expected to behave. We know that individuals are not in our hand. They behave as per their mood. Market is also not in our hand. Market has its own mood. So we should not try to time the market. We should not try to outperform the market. We should not be try to smart investor. What we can do? Better invest in the market. If you cannot beat the market, better buy the market. Move, flow with the flow of the market. That means you should invest in index based products. You should invest in index ETFs where you flow with the market. You flow with the swings of the market. So we are discussing regarding behavioral finance. Next, we will discuss what are the branches of finance. I have already told there are two important branches of finance. One is standard finance or traditional finance. It is based upon one concept: investors behave rationally. And there is another branch of finance which is emerging, that is known as behavioral finance. It assumes that investors behave rationally, not always. Most of the times they behave irrationally. Their behaviors are influenced by emotions, heuristics, and many other factors. So, in that context, how financial theory will adjust itself, that is known as behavioral finance. So, there are two branches of finance. One is standard finance, another is behavioral finance. Standard finance starts its operations with the start its journey with the theory of Harry Marquis. We know Marquis portfolio construction or Marquis model of optimal portfolio selection, where Marquis tells that there are three important factors one must consider while investing or while calculating a portfolio. What are those? One is expected return, another is standard deviation, another is correlation. We have to consider these three factors and we have to construct our portfolio in such a way that the risk will be minimized and the return will be maximized. That is the basis of standard finance. The standard finance based upon a concept that is known as EMH, efficient market hypothesis. What does traditional finance or standard finance assume? They assume that markets are efficient. What does it mean? It means all information has already been represented in a securities price or market value. That stock or bonds current price is its fair value. That means all securities are fairly priced. No security is overpriced and no security is underpriced. Traditional finance tells that one should not try to outperform the market. One cannot outperform the market because the markets are efficient. Better one should own the entire market. I have already told, better one should obtain index-based stocks, index-based products, index ETFs. This is the basis of traditional finance. But behavioral finance is just the opposite of traditional finance. In behavioral finance, encompasses insights from behavioral economics. It's the application of psychology, microeconomic to financial theories. It's the application of psychology, microeconomic theory to the discipline of finance. In this case, we study different psychological and mental filters with the help of which we can study the decision-making process of the investors. Next, behavioral finance assumes that investors are not rational in the real world. This is the most important assumption of behavioral finance. I tell it repeatedly, investors are not rational in the real world. When it comes to investing, investors make mistakes. They not only make mistakes, but they make mistakes frequently. That means investors frequently show irrational behavior. And on the basis of this assumption, a new discipline of finance has emerged. That finance is known as behavioral finance. Okay, so we'll discuss the behavioral finance. So we have discussed the behavioral finance. Behavioral finance is of a recent origin, and behavioral finance has got its popularity when two professors, one psychologist, that is Daniel Kahneman, and economist Vernon Smith, awarded Nobel Prize in 2002 for their work in behavioral finance. And once they got the Nobel Prize, the behavioral finance got its relevance. Now all the people are studying traditional finance and behavioral finance side by side. People have accepted behavioral finance as to be a separate discipline than the standard finance or traditional finance. So behavioral finance is a word coined by psychologists and economists to represent a concept that integrate the two areas. What are the two areas? One is psychology, another is finance. So it's a happy blending of psychology and finance. Now we'll discuss different financial theories. We know that there are two types of financial theories. Some theories are traditional finance theories And these traditional finance theories are based upon like CAPM, like EMH. These are based upon the traditional theories are based upon these four parameters. What are the traditional theories? Traditional theories are based upon these four assumptions. What are the assumptions of traditional theory? First assumption is both market and investors are perfectly rational. Then investors true care about utilitarian characteristics. Investors have a perfect self-control. They are not confused by cognitive errors and information processing errors. So these are the assumption of traditional theories. But the behavioral finance has different assumption. All together the opposite assumption. Behavioral finance theories, they are based upon the following assumption, just the opposite assumptions. Investors are treated as normal and not rational. A normal people is not a rational people. If he makes many irrational decisions, he is a normal people. They have limit to their self-control. One cannot control your emotion all the times while making investment decisions. Investors are influenced by their own biases. Investors make cognitive errors that can lead to wrong decisions. These are behavioral finance theories. Okay, so we are discussing regarding the difference between traditional theories and behavioral finance theories. And in traditional theory we have many theories like Marquis model, CAPM model, Black Scholes model of options valuations, EMH. These are some of the traditional theories. So traditional theories. So let's make a comparison between traditional finance and behavioral finance. A question usually comes: what is the major point of difference between traditional finance and behavioral finance? So first, traditional finance and behavioral finance. I have already told traditional finance is based upon a concept called arbitrage, which is given by Modigliani and Miller. What is arbitrage? When a person simultaneously buy and sell in two different markets to get the benefit of price difference in these two markets, that is known as arbitrage. The arbitrager buy in low priced market and he sells in high priced market, that is known as arbitrage. So in traditional finance the theories are given by Marquis, William Sharpe, Linter, Black, Scholes, Merton, efficient market hypothesis. These are certain theories of traditional finance. But behavioral finance is based upon prospect theory, which is given by Kahneman and Tversky. It depends heavily on quantitative methods. Traditional finance are mostly quantitative finance, but behavioral finance deals with psychological aspects of finance. Traditional finance assumes that people process data are correctly. It believes that investors are rational and market generate fair prices close to its intrinsic value. That means markets are efficient. So there are two important assumptions of traditional finance: peoples are rational, markets are efficient. But behavioral finance predict that markets are not efficient, peoples are not rational. There are many rule of thumb, heuristics. There are many emotions that impact the decision making process of investors. Investor view decision in term of risk and return, but in behavioral finance the decisions probably are taken on the basis of decision frame. It assumes frame dependence. Then as per traditional finance, people are guided by reasons, people are guided by logics, people are guided by independent judgments. But in behavioral finance it recognizes people are guided by emotions, people are guided by herd instincts, people are guided by heuristics. It argues that traditional finance argues that markets are efficient. We have told markets are efficient. What does it means? The correct market price reflect the all the available information. But behavioral finance tells that market is not efficient. Market is heuristic driven. Market is influenced by biases. There are errors. There are frame dependence. There are emotional factors. There are social influence on the behavior of market price. So market price is not equal to fundamental value. Next, EMH is the most important belief of traditional finance or standard finance, and they tells that stock price movements are random. Stock price follow a random what? There is no pattern in stock price movement, but behavioral finance assume that there is a pattern in stock price movement. Investors are influenced by some patterns. Stock prices are future estimate of forecast of what investor expect tomorrow's price to be. So people's expectations have an influence on the price of the stock. But traditional finance tells that the price of a stock is the present value of future payments associated with a stock. But behavioral finance tells that stock price are a forecast of what investor expect tomorrow's price will be. So behavioral, next we'll discuss whether behavioral finance is a science or a art. So before discussing this, let me first tell what is a science. Science is a discipline which is based upon rules. In science, we follow certain thumb rules, but in art, there is no rule. In art, everybody has its own rules. Cooking is a science, cooking is an art. You can learn cooking, but by learning cooking from the same teacher, 20 students will cook the same food differently. That is an art. So behavioral finance is both science as well as art. In behavioral finance, there are certain rules, regulations which we have developed by analyzing the behavior of the investors. But behavioral finance is also an art. We have to judge, there are certain psychological things we have to make our own interpretation. Everybody will make their own interpretation. So behavioral finance is both science as well as it's an art. Next, what is the application of behavioral finance in stock market? We have discussed that. What is the application? We know that behavioral finance biases to stock and other trading market movements which can be done daily. Broadly speaking, behavioral finance theories have been used to explain significant market anomalies. With the help of behavioral finance, we explain the market anomalies. What are the market anomalies? The market anomalies may be bubbles in the market, recessions in the market. Investors and portfolio manager have vested interest in knowing behavioral financial development, even if they are not a part of EMH. These patterns can be used to analyze market price levels and fluctuation for the purpose of speculation and decision making. So speculators are also using behavioral finance for making speculative activity. Investors are using behavioral finance for the purpose of investment decision making. Next, we'll discuss certain decision making errors and biases in behavioral finance. We know that there can be 4 types of errors or bias which influence the investor decision making. What are those 4 types of errors or bias? First one is self-deception. Self-deception. We'll discuss what is self-deception. Next, heuristic simplification. we'll discuss what is heuristic simplification, social influence, that is one, then emotion is another. So there are four biases: self deception, then heuristic simplification, next social influence, next emotions. So we'll study one after one. These are certain decision making errors and biases of investment decision making. First one is self deception. What is self deception? Self deception means it is a barrier to learning. In this case, we ignore the knowledge that we need to make an informed decision. We believe that we know more than we do. Self-deception, we deceive ourselves by telling that we know everything. One person cannot know everything. So we have to accept our ignorance and we have to search for new knowledge. Next, heuristic simplification. What is heuristic simplification? This is information processing errors, which are known as heuristic simplification. Next, emotion. We know that emotion is another behavioral finance bucket. In emotions, influence our decision making. People take decision on the basis of their current emotional state. So emotion plays a major role in decision making. Then social influence also influence the decision making process. Even though stock prices are high, people buy during Dhanteras. At the time of Dhanteras, people have a belief. Due to social influence, you have to buy something, you have to invest somewhere. So people buy the shares, even if it's little bit overpriced. This is social influence. Next, we'll discuss different heuristics and biases of behavioral finance. We have discussed different heuristics and biases. So what are different heuristics and biases which are important in financial decision making? So these are known as different anomalies in modern finance theories. What are those anomalies? What are those heuristics? We'll discuss. These are maybe different types. First, it can be cognitive errors, it can be heuristics, it can be mental shortcuts, it can be emotional bias. These are some of the errors of heuristics, or these are some of the biases that influence investment decisions. In this context, we'll discuss some of the important biases that influence investment decisions. What are those biases? First, we will discuss. First bias is representative. Next bias is anchoring. Next bias is overconfidence, loss aversion, regret aversion, confirmation, hindsight, hoarding, mental accounting, gambler's fallacy, money illusion, experimental, familiarity. We'll study one by one these biases. First, representativeness. What is representativeness? It is the most common bias that influence judging things solely based on how they appear. People judge a thing by their appearance rather than a genuine statistical probability distribution. People generally make judgment on the basis of appearance. If a stock price increases, people tells that it's a good stock. If the stock price decreases, people tell that it's a bad stock. They do not apply statistical probability distributions to give their judgments. So this is known as representativeness. Judging things solely based on how they appear is known as representativeness. Another is anchoring. Anchoring is a decision-making process in which quantitative judgments are impacted by suggestions when they are asked to make them. That means instead of doing quantitative judgments, peoples are influenced by suggestions. Peoples are influenced by tips. Peoples are influenced by rumors. That is known as anchoring. Next, overconfidence. What is overconfidence? Overconfidence, everybody know, this is usually interpreted as exaggerated sense of one's own ability. It has to do with a person overestimation or exaggeration of his or own capacity to complete a task successfully. People overestimate their skill of investment. So overconfidence and optimism combinedly cause investor to overestimate the accuracy of their knowledge, undervalue the dangers they confront, and exaggerate their capacity to manage events. This is known as overconfidence. Next, loss aversion. What does loss aversion tells? Loss aversion tells that if a person gain 100 rupees, he will get some satisfaction. And if the person lose 100 rupees, he will lose some satisfaction. But the agony a person feels by losing 100 is not equal to the pleasure a person get by gaining 100. Generally, it is seen that when people lose money, they are highly influenced or highly emotional. That particular thing, loss, impact them highly than the pleasure they get by gaining money. So all the people try to avoid the loss. This is known as loss aversion bias. They try to play safely. They try to not to take risk. This is known as loss aversion bias. Next, regret aversion bias. What is regret aversion bias? It arises from the desire of the investor to avoid the pain of regret they may have arisen due to poor investment decisions. People have already made poor investment decisions, but they do not want to regret for that. They want to hold on their particular stock. They do not believe, they do not agree that I have made a mistake. Next, confirmation. What is confirmation bias? Confirmation bias arises when investors have a bias towards accepting informations that confirm them they are already held believe in an investment. Suppose you believe that Reliance is a good stock. Even if its price comes down, you feel that it's a good stock and you buy it. This is confirmation. It's a bias that investor has a bias towards accepting information that confirms their already held belief in an investment. Next one, hindsight. What is hindsight? Another common perception bias. It's a perception bias. And hindsight bias is which is all about I knew it was coming. When the corona effect is coming, many people tells that I knew that. That is known as hindsight bias. It appears to be prevalent when people are emotional or moral overnotes associated with an event. Then hoarding. What is hoarding? The hoard instinct is another market phenomenon. We are told that there is a hoard mentality of the people. Generally, we know that most of the people buy at the time of when the stock market is at peak, and they sell at the time when the stock market is at lowest level due to hoard mentality. What the group is doing, you have to do this. You are influenced by the behavior of the society. Next, mental accounting. What is mental accounting? Mental accounting refers to different values a person places on the same amount of money based on subjective criteria, often with detrimental result. Same amount of money has different value for different places, for different persons. That is known as mental accounting. Gambler's fallacy. What is gambler's fallacy? This is also known as Monte Carlo fallacy. This fallacy rests on the belief that if something happens more frequently than normal over a period, it will happen less frequently in futures. Or if it is occurring less frequently over a period, then it will occur more frequently in future. इसका मतलब, let's say company is not declaring dividend year after year. You believe that in future it will declare dividend because it has not declared dividend for last 10 years. If a company has provided dividend for last 10 years, you believe that it will not provide dividend in future because it has already paid dividend in last years. This is known as gambler's fallacy. You believe what it is saying. You believe the opposite of what it is saying. Then money illusion. What is money illusion? In economics and behavioral finance, money illusion describe the tendency to think of currency in nominal term rather than real term. We know that people calculate money in nominal term. They never calculate the real loss. They tell that I lose 1 lakh, but what is the real worth of that 1 lakh? People do not consider real value. They only consider the nominal value. When we adjust the inflation effect with nominal value, we get real value. But people think only in nominal, they do not think in real, and this is known as money illusion bias. Experimental. What is experimental bias? Experimental bias occurs when an investor's memory of recent events make them biased or lead them to believe that the event is far more likely to occur again. एक बार कोरोना आ गया, हम सोचेंगे बार बार नहीं आएगा. एक बार स्टॉक का प्राइस गिर गया, हम सोचेंगे और आगे नहीं गिरेगा. ये एक बार हो गया. Then familiarity bias is when investor tends to invest in what they know. Suppose you know a company which is nearby you. आपके लोकेशन के पास में एक कंपनी है, आप उस कंपनी में पैसा डाल दिए without making analysis of the real worth of that company. So in this familiarity bias, people generally invest in those companies, in domestic companies, in locally owned companies without making proper analysis. This is known as familiarity bias. So there are many other biases which influence the decision making process of the investors. Next, we'll discuss different quantitative behavioral finance technique. So all these things we are discussing qualitative behavioral decision making. Now we'll discuss what is quantitative behavioral finance. Quantitative behavioral finance use robust statistical methodology to understand the behavioral biases. So it's a combination of statistical technique and behavioral bias. And we study the behavioral bias and make valuation of the stock on the basis of robust statistical methodology used in behavioral finance or behavioral biases. That is known as quantitative behavioral finance. Next, experimental finance. What is experimental finance? It's a new field in which use experimental methods to study behavioral biases. Here, the investigator conducts experiments. They used simulation techniques to study the behavior of the investor, and this is known as experimental finance. Now, in case of experimental finance, the experiments will not be like physical science, but it will be an experiment of social science. Next, so it cannot be that precise as physical science. Next, neurofinance. What is neurofinance? In case of neurofinance, this is a concept given by Kahneman and Tversky. Next, heuristics and biases are limited in explaining behavior of decision maker. So in this case, we study the human brain which process information, the basis for decision making. All the decision making are made in brain. So we study the human brain, and we use a technique called fMRI technique. What is fMRI? Functional magnetic resonance imaging technique. These are the scans which are made by neuroscientists to study the structure of the brain which create anomalies. So neurofinance is a new concept. It's the application of neuromedical science technology to use to study the behavioral finance. Next, emotional finance. Emotional finance is a separate discipline that examine how our emotions, both conscious and unconscious, play a major role in all financial decisions. So these are some of the modern developments in behavioral finance. So let me summarize my discussion. Behavioral finance is a new discipline of finance. Behavioral finance is somewhere superior to traditional method of investment. If we apply behavioral finance, we will study the market anomalies. And with the help of behavioral finance, we study several psychological factors that affect the behavior of market participants. What are the psychological effects? It may be hoarding behavior, overconfidence, disposition effect, mental accounting, anchoring. We study different heuristics and biases which explain irrational behavior of the investor. Why they show irrational behavior in the market, as a result of which it gives an explanation to why bubble arise in market. So the impact of these biases on investors' behavior and market is a discipline of in behavioral finance. So in behavioral finance, we have studied different keywords. We have studied behavioral finance. It's a combination of psychology and finance. We have studied EMH. It tells that markets reflect all available information. Then we have studied MPT. MPT means modern portfolio theories. It is helpful to find out optimum portfolio. We have studied prospect theory. We have studied regret theory. We have studied representative bias. We have studied anchoring, overconfidence, mental accounting, gambler's fallacy, hoarding, etc. We have discussed. Next, we will discuss some of the important questions on behavioral finance. So what is behavioral finance? How it is different from traditional finance? Discuss the meaning and concept of behavioral finance. Discuss different emotional bias that affect the decision of the investors, and discuss various cognitive bias that influence the decision of the market participants. Then what are the recent developments that are taking place in behavioral finance? These are some of the further reading materials. You can read these materials to know more regarding behavioral finance. Thank you. Thank you for attending my class on behavioral finance. Thank you all.